So Ascent started in December 2020. And basically it was just a group of us that wanted to invest together. So we went to a company called MG Properties and said, hey, if we come together and give you a single check, will you give us better returns? And so on that deal with MG Properties, it went from 8% to 10% preferred return. And that was only $2.5 million. And it was a painful 2.5 million. I'm pretty sure I called everyone multiple times to get that across the finish line. And that was our very first deal in 12/20/20. After that, around 3/20/21, we decided instead of doing single deals, we'll do a fund. So we did Ascent Multifamily Fund. Fun. And we had, I think, about 5 deals in there. It was about $10 million or so. Both of these are doing very well. After that, we realized that instead of being a small piece, we'd rather be a big piece of actually, sorry, we're just getting there. After that, about somewhere around August, around maybe somewhere between 6 to 8, 2021, we did CAF Multifamily Fund. So this deal was like a co-GP deal. Let me pull up. Where we are in the co-GP place. So we just put in a little bit of investment and there's a large JV partner that invests the big amount. So as a co-general partner, you put in around 2.5% to 5% of the total equity, and then someone else puts in 90 to 95% of the equity. And they have what is called major decision rights, which I'll go over shortly. After that, so, this was a access fund. This was a fund that had multiple access funds in it. This was a co-GP. And then we realized that we wanted the ability to make decisions. So major decision rights, property management, hiring, firing, budgets, really everything that's important. Even though the sponsor is running the show, we want the ability to be able to assist with that. Move this a little bit this way. Oh, yeah. Okay. So after that, we did a deal called McDow. Actually, it used to be called Tierra Santa and went into McDow. And that was a joint venture. And this was our first joint venture. Let me write actually in black, joint venture. After that, we did a deal called Altamonte. This was in Phoenix. This was in Florida, actually Orlando. We bought this from Disney. Okay. And there's a couple things we learned along the way. And I think if nothing else, we've learned a lot, right? So Access Fund, it was great. It was minimal work from us. However, we didn't get a ton from the sponsor, just 2% extra preferred return. And so we didn't think our value was really there. This one's actually, it has between a 7 and 8% cash on cash right now. So this deal is killing it. But we didn't have a ton of value to add. So people can just go directly, right? The fund was nice, but because we were the minority partner in all of those deals, yeah, we had nice diversification with a lot of people, but we didn't have control. And for the most part, that's been fine. But if we needed to take control of a property, we didn't have that power, right? Same thing with this co-GP fund. We were the minority partner, and so we decided to do joint venture where we have something called major decision rights, right? And this was in, let's see, this was in 2021. And most of the deals around that time used variable rate loans. I'd say about 80% of loans were around there. So this had a variable rate loan on it. We also invested for not cash flow, but to grow net worth, an equity multiple or an IRR, right? Those were the days where people were able to flip deals in a year or two, right? Equity multiple. However, we since then have only done deals that are fixed interest rate loans. And I've gone over that plenty times in the past. We'll link some stuff below to give you that information. Basically, fixed, it just takes a lot of interest rate risk out of the table. And it was fine during back those times. And this deal's actually doing okay. But there's a lot of risk involved with how interest rates are going. And even if you look at the treasury bills over the past couple of weeks, it's gone up and down and up and down. So the name of the game is trying to take as much risk off the table. The more you're likely to be able to predict how something's going to be, the more you can kind of plan around, right? So Altamonte is we did what is called a loan assumption, meaning someone had a 9-year loan on it and we were able to assume it, mean pick it up. And this was in early 2022. So a lot before you really hear about loan assumptions, we got one and a long one. We bought this deal from Orlando. One of the issues that this property had is that in Florida, insurance costs have gone through the roof. And even though our property hasn't had any problems with any hurricanes or anything like that, the insurance companies are leaving Florida because it's too expensive for them to actually insure people. So then the people that are left really have a monopoly, and insurance costs have been gone up crazy. So we haven't seen another deal that makes sense since that time. So we actually don't really invest in Florida, and we were lucky enough to get this deal before kind of the insurance premiums went up. And we got a fixed rate interest rate loan, which is thankful. The only reason the property is able to do well, because if it had high insurance costs plus a variable rate loan, I don't think that property would be doing well. After that, we bought Dakota Ridge. Dakota Ridge. This is a JV. This is a JV. And this is in Fort Worth, Texas. And depending on how the economy is, you want to buy in an area that is up and coming, right? Growing, which for those of you that live in Los Angeles, the areas that are like Inglewood that are going to do hot, where they're going to have the Olympics in a couple of years, the progress, it's called Path to Progress. And this deal was a path to progress in Fort Worth, Texas. Problem is, the interest rates spiked up so much that the progress kind of stopped, right? And this is a deal that is probably our toughest in the market. It seems to be doing okay right now, but it's one that, again, fixed rating, had a variable rate loan, and is our last deal in 2022, our last deal that had a variable rate loan. So, one thing we learned, always have decision rights, have fixed rate loan, invest for cash flow. Oh, you guys can't see that. JV, fixed interest rate loan, and invest for cash flow. Okay, I still have a little space. So after Dakota Ridge, we have Chism Park, another JV deal, and another loan assumption. So this deal is doing well. It's like 90 something percent occupied. Similar, this is in Oklahoma City, and it's facing similar issues that Altamonte is for insurance costs. But we know that when we sell this property, it's going to be worthwhile. However, we still, at this point, we're investing for growing IRR and growing equity multiple. So after, and this is late 2022. Okay, so at the end of 2022, 12/20/22, we did Enclave on Bethany. So here we got joint venture, cash flow. So the property's still distributing right now, despite interest rates. And we actually did something interesting. We didn't get a fixed rate interest rate loan, but we got agency variable. It's a 10-year loan. And then we bought an interest rate cap. The reason that we could do this is we can sell. It was a 3 to 4 year loan, a 3 to 4 year deal. And then we could sell at the end of 3 or 4 years, or we could buy another interest rate cap. And because we're investing in cash flow, we've been able to do monthly distributions since we bought that. So August 2023, you can see that there was a large jump between when we did that deal and when we did the deal after that, Cabana and Kanto. We just didn't see any other good deals on that time and ones that met all of this criteria. So this one was a JV. We had decision rights. There's a fixed rate interest rate loan, agency, and it was cash flow. So we've been distributing monthly since we bought it in August 2023. It was actually the only property we bought all of that year. And so, we always look kind of Bayesian, right? We look at what is happening with the properties and how we can do deals, because it's not just one flavor or one type of way to do things, right? Because there's been so much volatility in the market, you have to kind of adapt, right? Now, after that, in let's say February 2024, we did Metro Park. Now, this was way different than deals that we've done in the past. This was, all the other ones were equity deals, equity. This was preferred equity. And all the other deals were apartments. This was retail. So given kind of where we are in the market, you're able to get returns. Most of the time we try to aim for around a 13 to 15% IRR for equity deals. But here we were about to get 11.5 to 13%, depending on how much you return IRR as preferred equity. And preferred equity, the easy way to really think about that is kind of like a loan. So there was millions, tens of millions of dollars of the sponsor behind us to get paid. So it was really safe. So that's why we felt comfortable doing an asset class that we normally don't do. And when we invested in early part of this year, it was 60% occupied. And they said in a year, we'll get to 90%. They're actually almost at 92%, and it's just a couple months ago. So they have been doing very well in that property. And lastly, we have, so about 6/20/24, we have Sunrise in Chandler. So it's kind of really, this deal has really taken everything we've learned and incorporated it, right? So we have major decision rights. It's an equity deal. Fixed interest rate loan. It's cash flowing day one. So this is the deal that we're just about to close. We'll send an update on that pretty soon. The big update is that interest rates have dropped. If you've been paying attention to the treasury bill, so that returns on that deal, the cash on cash is going to go up for everyone. So nothing that people need to do. So that's good. So this is kind of how we evolved. And so let me kind of break down the two types of deals that we are looking at these days. So equity, right? Equity meaning that we are the owners of the property, right? So we want major decision rights. So that's a JV or a co-GP structure. We want fixed rate interest rate loan. Fixed rate interest. And that's agency. Agency. We want to invest for cash flow. So 4+% in year one. And going up for that. Right. And then we want to work with a sponsor that has a good track record. And we want to invest in areas that don't have significant natural disasters. And taxes. Reasonable taxes. So, you know, a lot of people have been talking about how Texas and Florida are such a great place to invest. However, right now, property taxes have been going up 20 to 30% in those areas. So it's actually surprisingly progressive because a lot of the tax is paid by property owners. But it's really hard to predict what your expenses are and to kind of really make a business plan if you don't know where 20 to 30% of your expenses are going to be, right? So this is on the equity side. So we also do preferred equity. And we have a preferred equity deal coming up in the near future after Chandler is closed. We want 10 to 12% IRR. We want significant. Shouldn't say words that I don't know how to write out. Significant sponsor capital. So the current deal that we're looking at, there's like 30 million in sponsor money behind us to get paid. That makes us feel comfortable, right? What else? And we're actually agnostic to type of asset. So Metro Park was retail. The next one we're looking at is hotel. Oh, here's another big one. And if you're doing preferred equity, really need to look at this. We want our last dollar to be at less than 70% LTV. Okay, so what does that mean? So what I have seen in the past is I'll see someone get a loan for 65%. It's really hard to get more than 70%. And a lot of people are giving 65 or less, right? So you get a loan for 65%, but then you put in 15 25% preferred equity, so that the leverage on the deal before when you're common equity, so these guys, common equity, is 90%. 90% of the value of the property gets paid before you. So for us, in that example, if it was 65%, like what Chandler is, 65% loan, right? Then we would say, hey, yeah, we'll give you 5% preferred equity, right? So say say it's like 6.5 million, be like, yeah, we'll throw in 500K, which it wouldn't be worth our while to do that. But just theoretically, if it was, or maybe let's say it was a $65 million deal, we would say, yeah, we'll do 5 million in preferred equity. And this money and then that means if it's like, say, $100 million deal, right? So the sponsor equity would be 30 million. So that 30 million would get paid after us. So that makes us feel good. Oop. You can't see that 30 million. So so it's like debt, and that's why, because preferred equity is like that, we combine both the loan and what we're giving as preferred equity, because we want to know how much of the money from the sponsor is behind us to get paid, right? And then sometimes there's a second loan and stuff, so you got to really look at who's in front of you to get paid. So any type of loan is in front of you to get paid, and who's behind you to get paid, right? And so we want there to be, including us, less than 70% of the total deal, because when people get too much leverage, it's nice, it juices your returns, but it also adds in a lot of risk, right? And we're not in the game to take over properties. I don't want to take over a property, right? I want to get this number 10 to 12%, and be able to give to our investors on a monthly basis. So these are kind of our two business plans: preferred equity, and equity. So Sunrise and Chandler is an equity deal. In our pipeline, that's the only deal that we have. It's just about closed, and we're actually investing a little bit more of our own cash because the rates went down so much. And our next deal is most likely going to be preferred equity in a hotel deal. So let me see if there's any questions. Don't see any, but I'll stand here for a few minutes if anyone has any questions about kind of where we are, what we're planning on doing. And I think this is kind of a progression of taking everything that we've learned, and being able to otherwise do well. Yeah. Let's see, what else can I tell you? Anything sticks out? The other thing about the preferred equities, you want to make sure what rights you have, right? So and this is a little more esoteric, right? If the common equity sucking, you want to have the ability to take the property, right? If they're not paying you, if they're just dropping the ball. But so if you're, in this scenario, you basically just got a 30% discount on the property, right? Because you're going to take over the property at 70 cents on a dollar. So it's a win for you, as long as the value of the property hasn't dropped more than 30%, which would be pretty rare for that to happen. And especially because you invest in something, we still invest in things that have fixed interest rate loans, the same as we do in equity, right? Fixed rate loans, cash flowing deals, and yeah. So we like preferred equity. We like equity as well. But there's just not as many equity deals out there. So okay, so Richard's asking how the current economic outlook is looking in the future. So in real estate, oh man, it's like you're like threading a needle, right? So you want interest rates to drop, but you also don't want a major recession. So you want like a mild recession where so that the Fed decides to drop interest rates, but you don't want rents to drop that much, right? So this is why we're sticking to, so this deal, the Sunrise in Chandler, the only reason we did it because the current loan on the property is 50 million and we're buying it for 46. So we're buying it for cheaper than the loan on the property. So that was a no-brainer, right? Otherwise, all the other deals don't really make sense because people overpaid in 22 and 23. That's why we only bought one property, especially in 2023. A lot of people overpaid. And, I don't blame them because the feds said that they weren't planning on raising interest rates that much. There's something called a dot plot. And it basically is like, kind of like this. And it just goes with what interest rates, 2, 2.5, 3, 4. And it tells you what kind of interest rates the people who are the head of the feds said it would be. And remember, back then it was 0%, right? Interest rates were 0. All the dot plots were within 2.5%. So literally every single person was wrong. Because where are we at right now? 5.25, right? So it was exponentially, right? Exponentially wrong. And so you just go with what they say. So everyone overpaid at that time. Fortunately, our deal we got a pretty big discount on, and it was later 2023. So we kind of had a feeling because interest rates had already gone up at that point. So we got lucky, right? We got lucky with that deal. But in the first half of the year, we didn't buy anything because there was so much volatility, and I'm really glad we didn't because we would have bought at the peak of the market, and then prices went down a lot. So prices have recovered a little bit, and interest rates. So interest rates, right? Your mortgage equals interest rates times purchase price, right? So with interest rates high, you expect this to go down so that this stays equal, right? However, okay, so let's say interest rates went up, right? So you would expect there to be really a major drop in price. However, we had like a 10%, 5%, right? Because people were hoping that this would be a soft landing or that things would recover, right? Because they recovered very quickly in 2020, right? Values dropped a ton, but then they pumped so much money into the system, it was kind of artificially kept up, right? So because of this, really no one has been buying anything, but we're starting to see purchase prices drop now, and interest rates go up less, right? So everyone says there's going to be a rate drop in September. It's probably going to be 0.25 or 25 basis points, but maybe it'll even be 50%. And there's a lot of money on the sidelines, literally hundreds of billions of dollars from people that have raised funds. A lot of people have raised distressed asset funds, but because purchase prices have been so high, they haven't been able to spend any of that money. And, they have two options: spend the money or give it back to investors. And they've been sitting on the money, collecting their 2% fee every year, and they're not going to give it back, right? So we'll probably see, once we start seeing interest rates go down, we'll start seeing people buy properties, and that actually might cause purchase prices to go up because there's going to be more people buying, because right now very few people are buying, and that's why we got Sunrise in Chandler at such a good deal, because people are scared to buy right now. But it's a lot of people think we've hit the bottom and we're actually going up. So Blackstone bought 10,000 units. Starwood bought a bunch. KKR bought about 12,000 units. So a lot of the big institutional players are starting to buy again. Okay, let's see. So Akash is talking about being able to stay at the hotel. There isn't, and I'm really bummed about that. But when it's a Hyatt Regency, when you own those larger properties, even if you literally built it, which this group built it, the management company is from Hilton. So Hilton's pretty smart. They kind of manage their own properties. Someone else takes the risk of building it, right? So you get a potentially we could get a small discount, but it's really tough to like this group, it's Simoon Group, it's the same group that did Metro Park. They have an office in the Regency and they have to pay for it. They literally built the thing and own it, but they still have to pay rent at the building. So yeah, unfortunately not. If we ever go when we go there to go check it out, we have to pay, some like it's almost too much work to get the discount, and it's not very significant. So yeah, none of that perk, unfortunately. Let's see. Okay, so Hamek is talking about fees. So what we do, so let me use Sunrise and Chandler, because that's a great question. So so a lot of people who do what we do, they have, uh two sets of things, right? So they'll have property level or fund level, and then deal level. Sorry, property or deal level, and then this is fund level, right? So they'll have like multiple waterfalls, right? So they'll do like a 80-20, right? 8%, 80-20, and then it'll be another 8%, 8%, 80, right? So this and then they'll have fees and fees, right? So when you have when you don't have a joint venture, right? When you don't have JV, the only way you as the sponsor are able to get paid is you have to charge investor money because you don't get a ton. So that's actually why we switched to joint venture, because we didn't want to do double fees. And it's also called double promote. So there's some very popular groups that are doing this. So it's important to ask, how many waterfalls are there? Are there double promote? Are there double sets of fees, right? So we do not do this. For us, for Sunrise on Chandler.
So it sounds like we're not doing the airspeed now. We
literally
were.
have no idea. It's
Oh,
like
okay.
the most ridiculous
We were
thing
not,
I've
and then we.
There we go. So let me give you Sunrise and Chandler as an example, right? Sunrise and Chandler. So the waterfall is 8%. So you get 100% up until 8% per month per year. Then you get 100% until you get your money back. So return of capital. Then you get 75%. And we get 25%. That's how we get paid. So Sunrise and Ascent share this 25%. One level of fees, right? Every dollar flows through this waterfall. Now, if you put in a little bit more, if you put in 150, you get 9%, and 80-20. If you do 300, you get 10%, and 80-20. If you do 500, you get 11%, 85-15. But this is the at minimum, which is 25,000 right now, and up from there, right? Fees, there's a 2% acquisition fee in year one. There's a 2% AUM fee starting year 2 to 5. There's a construction management fee, and that's 5% of CapEx, which is about 3 million. 3 million times 5%. So about 150K. And that's divided by all the investors. That's it. That's all our fees. There's no other fees. And Sunrise and Ascent shares in all these. Some people will have multiple asset management fees, multiple acquisition fees, multiple construction fees, but we try to keep really simple. So one of the benefits of going through us is that everything is simple and we really try to be transparent. So, other people will try to hide their fees, and we get called out because we try to be so transparent. But, we'd rather be called out and told that everything is too out there than trying to hide things, right? Okay. Okay. So the hotel deal is in Dallas. Dallas. It's gonna be pretty cool because sorry, where'd I go? So it's gonna be in Dallas. They're gonna be one of the hotels that got selected for the World Cup. So it's a really nice hotel. It unfortunately finished in 2020. So it's been struggling. It was struggling to get occupancy up, but now it's doing very well. And being one of the two select hospitals, one of the two select hotels for the World Cup means it's going to be pretty well. So I don't even know if I can get a room for the World Cup, despite being in the deal, but we'll see. We'll try to get it. Yeah. So it's in Dallas. Yeah. So yeah, as soon as we finish Sunrise and Chandler, we'll take a break, a much needed break, and then we'll get the Regency deal. So right now, Sunrise and Chandler is taking a little bit longer than we expected because of all the volatility in the interest rate markets. We've been kind of selective with when to rate lock, and that's benefited us tremendously because at the highest, the Treasury bill was 4.6, and now it's 3.8. So we're the interest rate could have been as bad as 6.4%, but we're going to be around 5.6%, which is actually 0.2% or so lower than we had underwritten. So it's benefited us to wait. However, we actually started everyone's preferred return. So everyone's money is earning money, and because we don't think you should be the one to suffer or have your money sit idle while we try to wait. But the waiting has really benefited us. Very rarely does the interest rate and stuff get better after by waiting, but this is one of kind of the rare times. So I think we're going to rate lock tomorrow, to be either tonight or tomorrow. So we should be able to close pretty soon. There's a little bit of space left. We already have enough to close. We just have a little space left to help us with CapEx and closing costs. But we already have enough to close, and we should do that pretty soon. And we'll be sending out an email update on that deal too. So sorry, my camera is like right where the chat window is, but yeah. Okay, so thanks everyone. If you guys have any questions, feel free to email me, Pranay at Ascent Equity Group, and chat soon. Bye.